So last week was a big week for investors. We had Meta, Google, Amazon, Microsoft, ServiceNow, Chipotle, and many others. The question is from their earnings reports, what did we learn about the companies, specifically the battles within tech, and what ultimately it signals for the broader economy? So let's look into that. Welcome to Inside Scoop with Sean Emory. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avery & Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. So let's kick it off with Google and Meta. I think, what do they signal about the consumer? Ultimately, these two platforms are platforms that drive advertisers. Advertisers invest in their business, on behalf of businesses that are looking to drive sales. So these are important signals to the confidence of forward-looking revenue, assumptions and expectations. Meta saw 23% growth this last quarter, and ultimately guided to high teens growth for next quarter. That incorporated some sort of conservatism based on what's happening in the Middle East. So the reality is, without that, and probably prior to that, numbers probably would have been higher, but net, a strong indication of what the consumer market is ultimately feeling. You saw that in 4.9% GDP, a lot of that coming from the consumer and consumption. There's all different ways we can dissect that point of view, but let's just focus on earnings. You've kind of flip it to Google search and YouTube, both advertising driven product lines for that business. And what you saw was strength on Google search. You saw strength again in YouTube, growing back in the double digits, the fastest growth for YouTube in nearly 2 years. And signals on the earnings call, indicating that they saw a trough and back to growth on that platform. So net, you take those two from a top down. This is really, if you're thinking of how you drive revenue, it's top of funnel. There's bottom of funnel as well, and that's why I'll skip to Amazon and their ad business, which is also the confidence of advertisers or companies to try to drive revenue. And the ad business at Amazon, grew in the mid to high 20s. It continues to grow as a percent share of the overall business, and you could see that type of advertising budget more as bottom of the funnel, meaning trying to truly drive conversion of a product purchase. And you could see like Meta and Google really top of funnel. If you're just comparing the two, meaning where are you trying to drive them in the process to drive either awareness or performance of your product or your business. So I think net, you take those three things combined for companies that are so large in digital advertising, and the digital ads market is, back to growth and back to, somewhat significant growth, depending on who you're looking at. Now, shifting, within those same companies and looking at the tech side, what is the health of tech budgets overall? I think Google and Microsoft and Amazon's AWS business give us some perspective there. So what did we see or view? You take Microsoft Azure, which you look at their overall cloud business. That's a $30 billion revenue business. Some of that is applications, the applications that they manage in the cloud, so it gets kind of booked into cloud revenue. You have Microsoft Azure, so people using their platform, their computing platform. their infrastructure as a service is kind of a way of framing it. That is continuing to drive growth. I mean, that's in the mid to high 20% growth. And the management team on the call signaled more growth ahead. You look at Google's GCP, their Google Cloud business, there was a little bit of hesitancy on that, mainly due to going from 28% growth to 22% growth. And then you look at AWS, uh, their growth was 12% growth year over year, which compares to 12% growth last quarter. So you're seeing stabilization in arguably the largest, infrastructure platform as a service. And on the earnings call, which was arguably most important, was they mentioned that they're seeing, or they saw several bookings that were larger than I think the entire quarter that will show up in Q4. The importance of that, again, it signals and likely pushes analyst estimates higher, because ultimately what they're saying is, the growth of last quarter is much stronger than the growth of the prior quarter, and therefore growth of the prior two quarters. So we can apply that. And one question though remains, was really around Google Cloud. I think that was the whole debate of earnings around on cloud spend. And if you think of Google Cloud, they've historically been known as machine learning. Ultimately, we all know Google is a search company at its core, and ultimately is driven by machine learning and AI, and has have been perceived as the leader in AI and machine learning. And I think that still holds true. However, the question is open due to the fact that Azure saw incrementally stronger revenue growth during the quarter, despite being much larger than Google Cloud. And a lot of that probably has to do with the demand for using OpenAI, and obviously Microsoft owns OpenAI essentially, and they're essentially using or selling generative AI on Azure. So you have companies out there that are already Microsoft customers. They're just as penetrated as anyone out there in the enterprise, and companies can decide to optimize and use everything from their applications to their infrastructure with Microsoft. And now you're seeing training and potentially LLMs or language models with Microsoft. So that question is still open. The reality is Google's coming out, or they have Bard, and Bard essentially has indicated that they're coming out with a new version of their model internally, and that model has been said to be just as good or better than GPT-4 from OpenAI. We'll see how that pans out, but I think they have enough money, resources, talent to likely achieve and catch up pretty quickly to what OpenAI has done. The question though is, OpenAI has taken the name. It's kind of become the noun of the category, and that can be a dangerous thing, but it doesn't mean that it's winner take all at all in this case. Overall, though, if you look at these three players, they're all growing, still fairly healthy. A couple of them accelerating growth, and the buyers of these tools are other companies, and they're not necessarily tech companies. They're all types of companies, spending annualized, somewhere around 150 to 200 billion dollars a year in cloud spend. And if that's growing, I think you combine that with advertising spend growing, it gives you a signal of the health of all the other companies that are ultimately the revenue of the big three or four that we're mentioning here. Combine, some strength in Amazon's North America and international commerce business. That also suggests some pretty healthy, indications for the consumer. You combine that with the 4.9% GDP I referenced earlier. Now, stepping back, if you look at earnings so far throughout the quarter, there's some interesting takeaways that I think suggest, again, if you're just focusing on the U.S. alone, if you look at S&P 500 earnings so far, the the S&P is growing earnings at 2.7%. So back to growth. But if you dissect between, companies that have the majority of their revenue in the US versus majority of their revenue international, there's a pretty big deviation. 6.8% growth for companies that are majority in the US versus 4.7 international. You go to the revenue line and it's 2.1% for the S&P more broadly, but it's 3.6 for, revenue with companies that have revenue with the majority in the US. So I think that's an interesting distinction. The next question then goes to, 2024, what does that look like? I think analyst estimates, they're up since over the last 6 months to today. And it's implying a pretty nice growth over 2023, which some have questioned, but we think is totally possible given everything I just talked about in terms of the health of, consumer and corporations and their spending habits, I guess today. The growth or the potential of earnings expansion, how does that come to fruition? It's either top line revenue growth on the same expense base and you get operating leverage, or you get, same revenue line and margins, contract. I mean, and expenses contract, getting up to operating leverage once again. And we think both are actually possible. We think a lot of companies are still somewhat optimizing their spend. And we saw that over the last year and a half. Companies have been preparing for this, inevitable recession that everyone's talked about that's never come about. And that's led to pretty, strong margins despite some stabilization in revenue. And should we get revenue growth by any stretch and any sort of continued optimization in spend, we ultimately think that leads to a pretty healthy, earnings power for the year ahead. And there's macro factors to get to discuss, but that's not for this conversation. I think net, you look at last week's earnings reports and reports up to now, there's pretty strong indication from, the highest revenue generating companies in the world suggesting that the advertising spend remains resilient, which signals what companies are thinking about potential consumption and conversion. And then lastly, you get consumption spend of technology and what that signals for these companies as well, and their willingness to invest in their business for the future. So with that, I'll talk to you next time,